Hello, today let us look at the accrual concept, and under accrual accounting, the effects of transactions are recognized when they are earned or incurred. Okay, what do we mean by this? We recognize revenue when it is earned. Okay, we recognize revenue when it is earned, and we recognize expense when it is incurred. Okay, let us look at practical examples to understand what do we mean by recognizing revenue when it is earned, and what do we mean by expense by recognizing expense when it is incurred. Okay, so here we have an example of an audit firm which has provided audit services worth amount of Kenyan shillings 1.5 million, and they have submitted all the deliverables, and they have issued an invoice in December 2025. However, the client will pay in January 2026. Okay, so the question is here, as the audit firm earned that revenue? And the answer is yes, because they have done what they are required to do so as to earn that revenue or to get that revenue. So for another example is, let's say for example you buy and sell cows. Let's say you buy and sell cows, and you have bought some cows, and now you've sold to another person, and you've taken these cows and delivered these cows to that other person, and they are yet to pay you, but you have delivered those cows. So you've already done what is expected of you to earn that the amount of money that they are going to pay you, even if they are yet to pay you. So in accrual accounting, we don't look at the movement of cash, whether they have paid you or not. We must recognize that aspect, the effect of that transaction of taking those cows to that to the person who was buying from you. Okay, so even in this case, you have to look that for this audit firm, they have already done all the work that they are required to this client. It is just that they have not yet been paid, so they have earned that revenue. So in accrual accounting, you recognize that that revenue as at that time, even if they have not yet paid you. Okay, so in December 2025, for this transaction, you need to recognize that that revenue, and because you are yet to be paid, you're going to debit what we call the account receivable, because we are expecting to be paid in January 2025. Okay, 2026. So you debit account receivable an amount of 1.5 million. Okay, then you recognize the revenue because you've already done what is required to earn this amount of money. So to recognize a revenue account, what do you do? Remember the expanded accounting equation. Remember the expanded accounting equation, and revenue, which is this, is on the right side of that equation. And when you want to increase this account, what do? You credit. Okay, the accounts on the left side, and when you want to reduce them, you debit. In this case, we need to recognize an increase in our revenue account, so we credit. We could name this account audit fees, but as mentioned earlier, each organization, depending on what they do, they prepare their own charts of account and classify them as whether revenue account, whether it's an expense account, depending on what they do. Okay, so this is basically a revenue account. Okay, so here we're calling it audit fee. Some organization would just call it a revenue or revenue account. Okay, so here we'll have 1.5 million. So you already see we have recognized the revenue even if we are yet to receive that amount of money. Okay, so in January 2026, what shall we do? In January 2026, we are just recognizing the payment. When they pay us, what are we going to do? We are going to debit the cash account, because now we have received money in cash. Okay, we have received money in cash, so we are going to recognize that we have an increase in the cash account, which is an asset account. Okay, and then the other thing is we need to decrease our other asset account that we had increased when we are recognizing that we have provided these services. Okay, so we need to reduce it because now we have been paid, so we need to credit the account receivable. We need to credit the account receivable by 1.5 million, because now we are reducing it because now we have been paid this amount. So at this point in December 2025, because we have provided these services, it is just that we have not been paid, we recognize revenue. That is what we mean by when revenue is earned. Unlike cash basis, we would have to recognize it at this in January 2026, because that is when we will have been paid. Okay, so that is the difference. Now let us look at what do we mean by we recognize expenses when they are incurred. Okay, so we have employees that have worked in December 2025 and have earned salaries of Kenyan shillings 1 million, but payment will be made in January 2026. What is happening here? These employees have already put in their level of effort during December as required, so they are expected to be paid because they have already done what is expected of them. So this is they have already earned their salaries, and we have already incurred that expense of them working. It is just that they have yet to be paid. Okay, so in December 2025 we need to recognize this expense because it has already been incurred. It has already been incurred. So in December 2025 we need to recognize expense. Remember, dealer, the simple word we use to remember when to debit and when to credit. Okay, and this is expense. So when we want to increase an expense account, we debit. So we need to debit salaries. Maybe we call it salaries expense. Okay, expense account, an amount of 1 million. Okay, 1 million. Okay, then the other thing we need to recognize is we have something we have not yet paid, which we need to recognize that liability that we have already. So we should have a payable account. We can call it salaries payable. Salaries payable account of 1 million. Okay, so this is basically a liability account. Okay, it is a liability account, and when you want to recognize an increase in a liability account, you actually credit that account. So this is what we do in December 2025. Note, we have already recognized expense by actually debiting the salary expense account. Okay, so here we have recognized the expense as at this point because we have already incurred. Okay, so in January 2026, when we make that payment, in January 2026, what will happen? We will have paid these people, so our cash account will be reducing. So to reduce the cash account, what do? We credit. Okay, so what are we supposed to be debiting? We are supposed to be debiting the salaries payable because we want to reduce this account. Now we want to reduce this account because now we have paid, so we need to reduce this liability account. To reduce a liability account, you actually debit that account. Then you credit cash because now money is going outward. To these employees. So this is what we mean by recognizing expenses when they are incurred, not necessarily when money is coming in or money is going out. No, the moment the effect of a transaction happens, we're not looking at whether the money has come in or out. That is cash basis. But in accrual accounting, this is how we do it. Okay, so let us look at the objective of this accrual accounting? Actually, the objective of accrual accounting is what we call the matching principle. And the matching principles requires a business to recognize expenses in the same accounting period as the revenue those expenses helped to generate. Okay, what do we mean by this? If I have earned revenue during the period of during the period of December 2025, any expense that I have incurred to assist me to generate this revenue should be recorded in December 2025 as well. Because if it was recorded in a different accounting period, let's say, for example, we recorded 1.5 million 1.5 million revenue in December, okay? But the expenses, let's say the staff salaries were recognized in 2026, this is 2025, okay? If they were, we recognize, maybe we had an expense of, let's say even 500, okay? During this period, when we calculate profit or loss, we are going to have very high profit because we pushed the expenses that were used to generate this revenue to the next period, which is not correct. So we want to have a fair representation of profit at when you're looking at a certain period of time. So during a certain period of time, we look at what are the revenues that we have generated during this period. We record them. Then also we need to recognize the expenses that have been incurred during that period to generate this revenue, whether they have been paid in the next period or coming from them, or whether they have been paid in the next period, okay? As long as they were used in generating this revenue, then they need to be recognized in the same accounting period so that the profit that we are saying we have incurred is fair to say, okay, this is what we incurred, this is what we've earned, this is the profit, okay? So let us look at a practical example to understand what we mean by this. So a business buys 10 laptops at Kenyan shillings 70,000 each in cash, and the business sells 6 laptops at 85,000 each in cash in the month of May, okay? So the first question we'll ask ourselves, how will we record this first transaction? So we have bought 10 laptops we want to sell. So we bought 10 laptops at 70,000 each. So we bought them at 700,000, okay? So at this point, let us assume it was in April, we need to come and debit what we call the inventory. Remember, we have received the laptops, okay? So we debit inventory, or rather the stock account, an amount of 700,000. For now, let us assume we paid in cash. If we paid in cash, we credit cash account, okay? But even if we didn't pay, we actually took in credit, then we need to recognize that liability by crediting the account payable. So in this case, we could also have, we didn't pay in cash. Let's assume we didn't pay. Okay, in our question here, we were saying we paid in cash. So let us first stick to payment in cash, then we shall work around if you are doing this in credit so that you understand, okay? So if we paid in cash, we credit cash account an amount of 700 because we have paid out, okay? Then the business sells 6 laptops at Kenyan shillings 85,000. So 85,000. Let me do the calculation. 85,000 times 6, that is 510. So 85,000 times 6 is 510,000. So they have made a sale of 510,000. The moment the business does that, we need to recognize this revenue, because now we have taken these laptops from our shop, we have taken them to that client that was buying. So what do? We are saying here it was paid in cash as well. So meaning we directly received that money. So we need to debit cash account, an amount of 510,000. On the other end, what do? We recognize this revenue because we have earned it, because we have delivered our fair share of what is expected of us, and it is these 6 laptops. Okay, so we credit sales account, which is basically a revenue account, by 510,000. Okay, so the moment we do that, now this is where the matching principle comes in. We need to recognize the expense that have been incurred for us to be able to generate this revenue. And that expense in this case, when you are buying goods or selling services, is what we call the cost of goods, if it is goods that we are selling. Okay, so in this case we need to come, cost of goods, it's a net expense account. We need to recognize that expense that now has happened, that has been incurred, because we are saying we recognize these expenses in when we generate when we generate a certain revenue, we need to recognize that expense in the same period that we have generated this revenue. Okay, so we need to debit this cost of goods, an amount of now how much did we buy these seats, because now we have sold only 6 laptops. So we are looking at the cost of buying these 6 laptops, and we bought them initially at 70,000. Okay, 70,000, even right? Yeah, yes, at 70,000. So we are saying here 6 times 70,000, we are going to get 420,000. Okay, so we are saying here we need to recognize this expense of 420,000 because this is the cost we incurred to be able to generate the revenue. We incurred the cost of buying this 6 laptop at an amount of 420,000, so that now we can be able to sell these laptops to earn 510,000. Okay, I hope that is clear. Then we credit. What do we need to credit? We need to credit our inventory. Our inventory is now reducing. It's now reducing by the amount of seats laptops. Remember, we had bought 10 laptops at 700,000, but now we've sold seats, so we need to reduce this for 20,000. Okay, so basically, you see, we end up matching the expenses to when we are recognizing the revenue as well. So that's how the matching principle works. So as long as you're doing accrual accounting, always you'll find that the objective of matching principle has to apply. Okay, so that is recognizing the expenses that have been used to generate a certain revenue in the same period. Okay,